Thank you for joining us today. 4 years ago, half of America was thrilled with the presidential election result, and half were angry and terrified of the period ahead. Today, the situation is exactly the same. Likely, things won't be as great or awful as currently imagined, but regardless, the stock market will be driven more by economics than politics. Widespread COVID vaccinations will provide an important economic boost this year, and particularly with such a closely divided House and Senate, overly liberal legislation will be difficult to pass. Having said this, the new administration will attempt to pass tax legislation that could materially affect investors, which Adam will now address.
Thanks, Lowell. And we're going to go a little bit off our typical script, which would be to first review just generally market performance and hone in on taxes, because as we all know, it's currently a hot topic given and now and any time there's an administration change, and also the fact that taxes will impact everyone. So a couple of things related to taxes. First, we'll talk about just where we've been in terms of historically regarding tax rates, both for income and capital gains. We'll talk a little bit about what's on the table in terms of agenda for the new administration and what their tax initiatives might look like. Then we'll talk about the likelihood of potential tax changes, the size and the timing of them. And then lastly, and the important piece is, what's our role as advisors in managing and navigating around any potential tax legislation. So first and foremost, I captured this from the Tax Policy Center website. This is a pretty long-term outlook on the trend of tax rates, both for ordinary income and for capital gains. And what this is mapping out is, for both of them, what has the maximum tax rate been over time? And you'll notice a couple of observations. First and foremost, that there was a point back in the mid-50s where the maximum individual income tax rate was 90%. And you'll notice that there's been a significant downward trend in the maximum tax rate over the past several decades. And you'll also notice that capital gains, outside of a spike in the 70s and a decrease in the early 2000s, has remained relatively consistent over time. So when you hear people reference that we're in a historically low tax environment, that is absolutely true, number one. And number two, as we think about the deficit and some of the other challenges we've got ahead of us, it seems fair to say that tax rates, if not this year, next year, but down the road, are more likely to go up than they are to go down. So that's some context where we're coming from. And when there's the campaign cycle and when you have a change in administration, everyone comes in with grand ideas and a very robust agenda of, in a perfect world, what is it that they'd like to implement. And so what I'm going to do is quickly just take some bullet points from what's known now as President Biden's tax agenda. What are some of the things that are top of mind and are on the table for legislative purposes? And the first thing I'll say is, there's been a pretty clear line in the sand drawn by the Biden camp that says they are not going to raise tax rates on those making less than $400,000. That seems to be the magic number. If you fall below $400,000 in income, they've verbally and in written form put out there that they don't have any anticipation of raising your taxes. The second is that those above the $400,000 hurdle, and especially over the $1 million in income hurdle, there's talk of tax increases. First and foremost, the big ticket item is being a raise in the income cap and a reintroduction of the income cap for the Social Security payroll tax, which now cuts off at the mid-100,000s, is set to kick in again potentially above $400,000 in income. So over $400,000 and $1 million especially, it's on the table for potential tax hikes. A reduction in some itemized deductions or a phase out of those is also on the table. And then two things related to capital gains, potentially capping in making changes to the rate at which capital gains are taxed, especially for those over $1 million, and also the taxation of capital gains at death. Those are two things on the cap gains front that have been put out there. And lastly, some maneuvering and adjusting around some of these tax credits, specifically the earned income tax credit and the child tax credit, both of which were changed during the last tax Reform Act of 2017. That's probably a clear way for Biden to give tax cuts to the lower income group is through these tax credits. And so I think that's certainly, something that'll be up for discussion. And now the big question becomes, is any of this going to be implemented, and what's the likelihood of any of this getting implemented? So we know the ideas, but is this really going to happen? And a couple of things that I would consider headwinds to President Biden during his first year in office, really three things that could cause some disruption or a slowdown in a plan of any kind of a tax rollout would be, definitely through the first half at least of this year, a heavy focus on the pandemic and getting the vaccination plan rolled out could cause disruption or a distraction from any major tax reform. Number two, the moderate bloc of Congress and the influence that they're gonna have on any tax bill, either small or large. So, there's a moderate group that's going to have some say in the direction of tax changes. And so the negotiation process and the back and forth there will be something to watch. And then lastly, once we get through 2021, we'll be right on to midterms next year. So at that point, a decent-sized group will be worried about reelection. And so it's typically and historically not super popular to raise taxes in and around midterm time. So some things to watch in terms of the possibility of any of this happening. And, I'll pivot to our role in all of this. And obviously we'll have our ears to the table in terms of what might be happening and what's up for debate and what we're hearing in terms of planning opportunities and potential changes. But it's our job to help understand, what's coming to the table and help communicate to clients, how we might want to navigate around these things, or if we need to take action or not take action. That'll be something we'll work closely with you to better understand. And a big point of caution is, when you read things in the headlines around tax changes, they tend to state things very broadly. And taxes is very unique and personal to all of us in that, rates might go up, deductions might change, but, we all have a different set of circumstances into the type of income, the level of income, and how our tax returns, integrate together. So we'll be there to kind of help communicate along the way of what we're seeing and hearing. But these are just some things to think about as we head into a new administration. So from the general, overview and a look at the economy, many of the world's largest economies, they still appear to be in the early stages of the recovery, mainly supported by a few things, robust manufacturing, a booming housing market that's really being helped by record low mortgage rates and high demand for pre-owned homes, and corporate profits that are rising and also recovering at the same time. And on top of that, as a tailwind to the recovery, we've got continued government stimulus and support from the Fed, mainly a commitment from the Fed to keep interest rates low and for the foreseeable future. So this help from the government and the Fed, it's likely to help bridge the gap between where we are now and a full-fledged reopening expansion, which is what everyone's got their eyes towards in 2021. And just from a numbers perspective, the International Monetary Fund estimates 2021 global GDP growth to be just actually over 5%. And for the U.S., the consensus forecast is somewhere in the neighborhood of 3%. So certainly a much better picture than what we saw at the bottom of last year. And a realization of these numbers is going to be a function of how quickly we can roll out the vaccine and how countries globally manage this from a logistical standpoint. And so if you try to think about what are some potential disruptions to our recovery and the markets throughout the short term, a source of volatility could absolutely be a disruption of the vaccine rollout and the reopening plans for the economy. So that's just a flag of caution to think about. A longer term, more realistic concern that's also out there and being discussed amongst clients and questions that we're fielding from clients is around, the growing deficit and the debt levels in the country. So as these stimulus bills are being passed, clients are asking, what is this going to mean as our balance sheet balloons and our debt levels skyrocket? What does that mean long term? And so I think a realistic expectation is for lower growth long term and lower stock market returns. If you look at just the markets in general, baking in more realistic expectations into your assumptions for your asset growth, the mid and high double-digit returns we've experienced through a lot of the expansion over the last 10 years, how does that translate to the future with more debt on our books? And I think, and most people would agree, lower potential returns. And so before we jump into asset class returns, one thing I wanted to point out is just the magnitude. You think about, the economy and the fluctuations in the market, but also understanding what are some of the short-term hits that we took last year in terms of the sell-off from February to the end of March. And I've got this here mapped out to show, you think of a recession, and what does an average recession look like compared to what the recession last year looked like for us and for clients? And you think about a couple of things, the size of the drawdown in the markets and how long it took. So the average recession since 1960, the average, top to bottom drop in the market was about 30%, just over 30%. It took on average about 340 days to get there. We had that same amount of drawdown, but only over a 23-day period. So you think about just what our clients were able to get through last year and the discipline it took to do that. With the headlines surrounding it, it's really amazing to watch what happened, and we're proud of our clients, for sticking in there and staying invested, throughout all of it. And one of the things I think will be really interesting to look at as data starts to roll out a couple of years down the road is what was the behavior of other investors through 2020. And this is a mapping of the pink line being the S&P 500 during the great financial crisis, and the blue bar chart at the bottom being, the blue bar graph at the bottom being movements to cash, and particularly money market funds. So the long and short of it is, what this is showing is that at the bottom of the market, you saw a peak in cash deposits. So it helps highlight the fear factor of volatility and decision-making around that when it comes to investing. So I think we'll see something very similar to this, and the early data points to similar, investor-wide behavior during what happened this year. And so it kind of goes to show you, and as we said during our March webinars, discipline is key, number one, and the fact that a lot of these cycles and these sell-offs in the market, although they feel somewhat different, oftentimes end up looking very similar in terms of their behavior. So what actually happened specific to Q4, and then we'll also take a longer-term outlook on an asset class basis. But certainly fourth quarter of the year, even with the concerns around the election and the runway for the economic recovery and how the markets would close out the year with concerns around the second wave of COVID, you saw pretty solid, strong double-digit returns across global asset classes, pretty consistent, whether it was domestic or international, developed or emerging markets. So building on that trend from really the second and third quarter of a robust recovery. And with that, you saw a fairly flat bond market. So it was kind of a tale of 2 years, where Q1, you saw a really sharp sell-off in equities and a really strong drop in interest rates, which translated to positive bond performance. in the first part of the year, you saw kind of the opposite happen with a flat bond market and a rising stock market through the rest of the year. So a lot of this really driven by getting over the hurdle of just the election process, and the vaccination news was huge. We saw a couple really strong performance days related to that. And longer term, if you look out last 1 year, 5 year, and 10 years, there's a couple trends that I think are really important as we look backwards, but also forward. Is the theme the last decade has been fantastic returns for domestic markets and pretty below average returns for international developed and emerging markets on the equity side. So you hear a lot about diversification and globalization and having balance in your portfolios, and this has been a pretty historic decade run in terms of the outperformance of domestic versus international equities. And within domestic markets, and something Andy will touch on, is just what the differences has looked like in terms of large cap versus small cap, and more importantly, value versus growth. So you hear a lot about markets in general, but under the hood of the U.S. market, there's been a pretty big performance divergence between value and growth, which is important on a forward-looking basis because we know what happened already, but what's likely to occur in the future, and where do we want to best position our clients for success in the future based on where we are. And so that's the benefit of active management and being able to not be beholden to any index, but to be able to shift through time as the dynamics of the market change. Lastly, on the bond market, really amazing. You look back 10 years ago as we were coming out of the financial crisis, so much of the talk was around low interest rates and that rates have to go up and that bonds are going to get crushed when that happens. But it's been a very essentially smooth sailing the last 10 years, 5 years, and last year for fixed income markets, with rates staying level for a period, but then starting to fall significantly last year as we were shutting down the economy and there was a flight to safety, rates falling and bond prices going up, boosting performance. So certainly backward looking has been a pretty average return environment for bonds, but one of the things that we're thinking about from an asset allocation perspective is, what does that mean going forward? What do we need to do within bond allocations to account for this and what that might look like? And before I pass it over to Andy, I'll say one thing. In our March webinar, it was a town hall where we were fielding questions for clients. One of the things that we said at the point of discussion was, when all of this volatility calms down and when the markets start to recover to a more normal point, that's the time to start to revisit and discuss your asset allocation. So when things are calm and feeling relatively normal, this is the time to be speaking with your advisor and revisiting the level of risk you're taking and whether or not it's appropriate to make any changes. So it's easy, when the markets, especially equity markets, are really robust and strong, to sit back and feel really confident. But now is the time to be thinking about the future and whether or not you should be making changes based on your overall plan. So with that, I'll pass it to Andy to talk about growth versus value.
Thank you, Adam, and thanks everyone for being on the webinar today. We are going to round out today's webinar by discussing some of the lessons learned in 2020 and reviewing some of the steps we took to navigate 2020's highs and lows. But first, we talk a lot about the concepts of growth and value when we're talking about our U.S. equity strategies. And I wanted to take a step back to make sure everyone understands what we mean when we use those terms. At its core, stocks are classified as growth or value based on the price paid for owning a company. And by price, I do not mean the share price, but rather, I mean how much you pay for $1 of a company's earnings. Keep in mind that when you're buying a stock, you're buying a claim of ownership on the company's future stream of earnings. So it makes sense to think of price as a multiple of the firm's current revenue or profits. Think of growth and value on a spectrum. Value companies can be purchased for a lower price multiple, while growth companies can be purchased for higher price multiples. Let's use the well-known price-to-earnings ratio as an example here. you might be able to buy the cheapest companies for 5 or 10 or 15 times their earnings. These would be considered value because you don't have to pay as much for your claim of that $1 of the company's earnings. You might think of these companies as being on sale. But on the flip side, you might be able to buy the most expensive companies for 30 times earnings, 40 times earnings, or even much higher. These would be considered growth companies because you have to pay much more for your claim on that $1 of the company's earnings. Think of it as these companies being priced at a premium. So we can group together the cheapest and the most expensive companies and call them value or growth. But why are some companies relatively cheap or expensive? And what does that mean for investors choosing to hold them in their portfolios? It all boils down to growth expectations. Value companies are cheap because the market does not expect them to grow their sales and earnings at as high a rate as growth companies. And to compensate investors for lower growth, the valuation multiples have to be lower. Additionally, these companies oftentimes reward shareholders by paying dividends or buying back shares. The phrase return value to shareholders is uttered a lot in the value space. With growth companies, on the other hand, there are much higher growth expectations. Investors pay for the better growth with higher price multiples, and the firm has to continue growing at a fast pace to justify the higher price tag. As a result, these companies rarely pay dividends or buy back shares, but rather are able to find profitable investments internally to invest in. You'll hear the phrase reinvesting back into the firm a lot in the growth space. So value companies are cheaper, but don't grow as fast and return earnings to shareholders, while growth companies are more expensive, but have higher growth rates and spend a lot on research and development. But which style of investing is better? We would argue that the answer is it depends on the market phase. But over the long run, value has held the edge over growth. There are two main reasons why value does have that long-term edge over growth. And the first is a behavioral reason. Value companies are inherently tougher to own than growth companies because they are more often in a drawdown and no one likes buying stocks that have fallen out of favor. So to compensate value investors for biting the bullet and owning these out of favor stocks, there must be a return premium. And the second explanation is that growth companies have lofty expectations to live up to. They are under immense pressure to continue growing at the double-digit growth rates that are needed to justify their price. And that can be very hard to do. The market is harsh on companies that fall short of growth expectations. So when a growth company has a bad quarter, their share price can plummet. But over the past decade, growth has actually outperformed value. This chart shows the performance of value stocks versus growth stocks going back to 1926. For the first 84 years, as we can see, value held a substantial edge. But that all shifted in the 2010s. And one of the reasons for this is that growth companies really did manage to live up to their expectations for much of the decade. Firms like Amazon and Facebook and Apple generated outstanding profits and were able to successfully launch and scale new offerings like AWS, Instagram, and the iPhone. While the decade was good for all stocks, it was especially good for growth. The last 3 years, though, have been a little bit of a different story, and things are beginning to look a little stretched in the growth space. Over this time, the share price for growth companies kept growing, but value really struggled, even though we didn't see the same fundamental outperformance in the growth space relative to value. As a result, this created the largest return gap between value and growth on record. How long can this continue? Well, the data presented here is through June of 2020, and we've already seen growth momentum cool over the second half of 2020. The most dangerous words in investing are "this time is different," as regression to the mean is a powerful force. Keep in mind that recency bias may make it feel easier to invest in growth companies today, but it is important to look at all of the data to manage expectations. Value usually outperforms growth, and we are expecting the pendulum to swing back in value's direction. And now that we're in a new year, I want to take a moment to look back at what was maybe the longest year of our lives for any lessons learned during 2020. First, and really the first thing that jumps out to me when reflecting back on the year is that the stock market moves faster than ever. This was the fastest bear market from all-time highs in history as stocks fell off a cliff in March. However, the pain really didn't last that long as the market bottomed on March 23rd and has relentlessly marched higher ever since. We saw it again in the fourth quarter with small cap stocks. Even while the S&P 500 was up, the small cap Russell 2000 remained negative for much of the year. But that all changed in a matter of months as small caps furiously rallied to pass large caps all in the last 3 months. And the second thing that jumps out to me is that the stock market is not the economy. Just look at the second quarter of this year. GDP shrank by 31%, far greater than what we saw in the worst days of the great financial crisis. Yet the S&P 500 was up 20%. So here we are in the middle of a recession, locked down in our homes, with our understanding of the pandemic making things look worse all the time, but the stock market just keeps going up and keeps going higher. It's important to keep in mind that economic indicators are inherently backwards looking. We normally don't know we're in a recession until after the fact, while the stock market is forward looking. And that oftentimes is enough to explain when the stock market doesn't always make sense in the moment. And that leads me to my final point here, and that is that market timing is a bad idea. Investors who went to cash in March may have avoided some of the sell-off, but many are still waiting to get back in as stocks march to all-time highs. This is a great time to remember that it is very difficult to predict how the stock market will react to the news. The 3 worst days of the year happened on March 16th, March 12th, and March 9th, with single-day drops of 11%, 10%, and 8% respectively. The 3 best days? March 24th, March 13th, and April 6th, with single-day moves up 9%, 8.5%, and 7%. The best days in the market are almost always clustered around the worst days, but it's imperative to be invested on those best days. Some more recent examples of surprising stock market moves. Many were concerned that a potential Biden win in the election would cause a market crash, but the S&P 500 rose 13% from election day to the end of the year. The siege on the Capitol shocked Americans across the country, and it occurred in the middle of a trading day, yet the stock market stayed green. And the last recession that we remember was 2008, and that was accompanied by a crushing housing crisis that made the recession feel so much worse. And many feared that another housing crisis would be on the way. But instead, the housing market boomed, and housing prices have never been higher. So to reiterate what Adam said with his comments earlier before he passed the baton over to me, now is a great time to reflect on your investment plan, reflect back on how you felt in 2020, both during the downturn and as the market came back. And think about, if there's any changes to your allocation that you want to make. As he mentioned, now is the time to make those tweaks rather than in the middle of a market crash. And finally, I wanted to shift to things we did. So we talk a lot about how market timing is hard, and that's true, but that doesn't mean that there aren't actions to take when markets sell off. There are 3 big things we did during the course of the year that had a positive impact on our returns. And the first one is that sometimes the best action is inaction. We never considered going to cash and held steady during the worst of the drawdown. And this is really because there's not much you can do in the middle of a bear market. You don't know when it will end, and the correlation of stocks increases substantially. So there's no use in rotating between different stocks. But eventually bear markets do end, and we made 2 tactical changes starting at the end of March. First, we shifted our allocation towards small cap stocks, as small caps tend to do well coming out of stock market recoveries. This was especially beneficial because small caps sold off more than large caps during the bear market. So we were allocating away from stocks that held up relatively better into cheaper small cap companies. And as we discussed, this was a big boom to performance here in the fourth quarter. The second thing we did, and this is probably the single most important piece of research that came out of our research department over the past decade at least. And that is that we turned on our distressed interval stock selection model. We know from past sell-offs that our normal model does relatively well in downturns and relatively poorly in the stock market recoveries that follow. So to counteract this phenomenon, we build a second stock selection model during market crashes trained solely on past distressed intervals and their ensuing recovery. This model was exceptionally effective, and we aggressively implemented it over the course of 2020, resulting in the purchase of our best performing stocks like Taylor Morrison, Renewable Energy Group, Canadian Solar, Match Group, just to name a handful. We expect this model to remain effective over the next 12 months, as it tends to remain effective for at least 2 years following the bottom of a market crash, which, if you recall, was March 23rd of 2020. And the silver lining of a bear market, though, is that there is lots of opportunity during the course for tax loss harvesting. While longtime clients probably noticed more trading than they're accustomed to, we were able to aggressively implement these changes that I just talked about while largely offsetting gains with losses. It wasn't uncommon to see double-digit returns at the end of the year with no real 2020 tax liability to show for it, as we were able to implement tax loss harvesting year-round. Tax loss harvesting really should be a year-round game, not just something we do at the end of the year to manage taxes. So to say 2020 was challenging would be an understatement, but congratulations, guys. We all made it to 2021. I think that we're beginning to be able to imagine a more normal future. And I just wanted to take this moment to thank all of you for being on the webinar and sticking with us through this year. We appreciate all of our clients. We understand that many people have been scheduling time with their advisors already, but if you haven't done so, now is a great time to do that, as they will be more than willing to talk to you about anything we covered in today's webinar, as well as some more personal things about your portfolios. All right, thank you, and here's to 2021.